G'day and welcome to this week's video. My name's Rob Gowdy from Consortium Private Wealth, and this week I thought I'd put together a quick presentation on market volatility and what we should do during market downturns, what causes them, how we react, and what we do when we're listening to the media and looking at our portfolios. So it can become a really psychological game, highly emotional. We all work extremely hard for our money, so making sure that we're doing the right thing with it's important, but it's always very difficult when we see the markets go down, and how we react is vitally important. So we'll cover off market volatility, corrections. Obviously we've seen a lot in recent times. It was only coming up 2 years ago where we saw a crash, and that's where the market in Australia went down 37% from the peak to the low. So let's just kick off the presentation. This is our disclaimer. This is general advice only, so we don't take into account anyone's personal needs or objectives when putting together this presentation. So corrections happen all the time. In fact, they happen nearly every 2 years. In fact, a little bit less. So it's a common occurrence, and a technical correction is where the market declines by 10% or more. So these things are normal. It's a common occurrence, and there will be plenty of corrections ahead of us, and there will be crashes ahead of us as well. And this volatility is just something we need to get used to, and it can also be seen as a buying opportunity. Unfortunately, when we have these crashes, obviously the media need to report about something. That's their job, and as a general rule, the media loves market volatility. So it's seen as bad news sells, so they love it. And this can have a bit of a domino effect. It makes people look at their portfolios, because we've got the apps. We can log in on the computer, check our app. You can get a balance at the end of each day. So when you're seeing balances come down, then you go home and see the news, and you see $40 billion wiped from the Australian share market. It doesn't make us feel good, and it can push us into a position where potentially you can make bad decisions. So markets in the short term are obviously driven by fear, and they're driven by greed, and that's part of the ebbs and flows. We know now that at the press of an enter button, or a click on the phone, pressing an icon there, that we can very quickly and easily sell all our holdings, and that can be millions of dollars worth, and it can happen with an instant based on how we feel personally, rather than our rational brain as investors. So whilst I say markets react in the short term, they're driven by fear and greed. Over the long term, share prices and markets are driven by increasing revenue and increasing profit. That's what drives the valuations of any asset over the long term, not how someone feels on a short-term basis. I've put together a bit of a list of why do corrections happen. Obviously they happen all the time, and it can be geopolitical risk. We've got Russia issues at the moment. We had North Korea in the past, and there's obviously a lot of tension with China and trade issues. And obviously the COVID vaccine, the COVID itself, markets become overvalued, and they just need to correct. That's part of that. People become greedy and are buying when it's expensive. And of course markets become undervalued, and they need to retrace. Investors become fearful. That's the emotional, psychological side of things. There's been lots written about that. Of course, the media then pump up the fear, which makes the people's anxiety worse, and forces them sometimes into a sell position. Debt-related bubbles. So the GFC was exactly that. But in reality, none of this actually matters. There will always be another reason why there's a crash. But at the end of the day, these things happen on a regular basis. There will always be some reason that the media attributes to it, and that's fair enough. We need to understand these things so we make better decisions in the past. But it doesn't really matter. They're going to come and go all the time. It's how we react when it does happen is what matters most. When there's a significant correction, what do the businesses in our portfolio do? I think it's a really important question to ask, to say, well, what are businesses doing when there's a crash or correction? So what are the people doing at Amazon, at Google, Microsoft and Apple? Are they sitting in a corner shivering and shaking and worrying about the 10, 15, 20% decline in their share price? I don't think they are. I think these are people that are highly passionate, hardworking, very smart people. They continue to improve their businesses, products and services. They are creating new products all the time. A good example of that is probably 5-6 years ago, the AirPods. I haven't got one here, but Apple's AirPods, cordless, from your phone to your ear. I go running with them. They're fantastic. That didn't exist 5 or 6 years ago, and Apple have around 60% of that business. So they continue to improve their products and services. They continue to reinvest into their into these products and services. That's retained earnings. And some of the stats that I read over the last few years, so Google and Amazon are spending in excess of $25 billion per year on research and development. They continue to complete transactions. Great examples of that in recent times is Microsoft. Just spent nearly $69 billion on a gaming developer. CSL just spent $12 billion on a Swiss pharmaceutical business. This is all about, like I said earlier, what drives the value of any business. It's earnings and profit. This is all about increasing future earnings and profit. So they're not focused on short-term price movements. And my suggestion for clients is that you shouldn't be so focused on the short term. And I think how often you look at your portfolio is really important. So if you log in often, you're going to see every ebb and flow on a daily basis. And I do have clients that look often, and that's fine. They understand the market. It doesn't affect their mood or stress them at all. And they probably are watching and looking for opportunities to buy. So one other thing that I've noticed, I can talk to any client, everyone remembers, as I do, the high watermark of their portfolio. What was the peak that it ever got to? We always remember that number. And anything below that is bad. But it's going to happen. When you have big run-ups in the market, we need to expect some sort of downturn at some stage, particularly for share markets that trade every day, or every working day at least. So checking too often can be psychologically exhausting. We have some clients that do that, and I know that it does stress them. And my advice to them is, if it stresses you, it might be worthwhile reducing the amount of times you check your portfolio, or only look at it at the review date with your financial advisor. Don't listen to the finance reports. It's not going to help. They're going to pump up the bad news, which in the past really used to annoy me, but now keep pumping it up. That'll means more people will sell, which means there'll be better buying opportunities when the market comes down. So news reports will be mostly negative. It'll just increase fear and anxiety. So what are your options when a market corrects or crashes? And for clients that have been with us for nearly 25 years, we've handled these type of events, and we've seen 3 significant share market crashes. This is one of many corrections that we've been through, but you've got three options essentially. Worst option is you sell when the market is down. It's emotional investing. Please avoid it. And that's no different from moving within your super fund from growth to conservative. You're still selling out of growth assets, businesses that trade on the stock exchange while they're down, and moving across to conservative. So that's the worst option in my view. A good option is to hold. Our long-term strategies do not change. We know where we'll get the best results over long term. And your best option is to hold, and if you have cash reserves, buy more cheap, high-quality businesses while the market's down. So what else can you do? Instead of watching share prices, because watching a share price or barracking for a share price tells you nothing about a business. So if you have some stress, just watching the share price and it's not where it was previously, the high watermark, it's not going to help you feel any comfort at all. So it tells you nothing about the business you're investing into. So what I'd recommend, and what I enjoy, and I understand that not everyone enjoys doing this, is go through and read the latest presentation from the business, from their quarterly. If it's a US business, there's heaps of information out there. You've only got to Google it, and half yearly in Australia. Read the CEO's letter to shareholders. This gives you a great example about how these people think, and often these CEOs and the people running the businesses founded the business. They own a lot of it themselves, so their shares are going down in value. And probably one of the best CEO letters to read is Warren Buffett's Berkshire Hathaway. Readily available on the internet. This is free information to download. Go hunting. So understanding the business you invest into at a deeper level can provide the more confidence you need to buy and hold. So I really highly recommend that you do that, particularly if you've got an interest in investing. Don't just watch share prices and barrack for them to go up. Go and understand the business, and if you understand the business and what it's doing into the future and how it's reinvesting and growing, that will provide significant comfort for you. And obviously we need to make sure that when we're paying out pensions for those in pension mode, we've got adequate cash, and that will stop us from ever needing to sell our awesome businesses to fund income needs. I think it's also important that we remember our time frame when we're investing. Now, I've covered this off a lot in the past, and I remind my clients all the time, it's not until age 65 or age 67 or 70 when you retire, it's your life expectancy. So when I'm talking to someone who's 65, I've got a husband and wife in the room, I'm expecting one of those, or both of them hopefully in good health, to make it into their 90s. That is your investment time frame. It is a long time, and we calculate out to 93 for most of our calculations. Just to finish off, a few simple graphs. This is just the All Ords. It shows the COVID crash here. It's a little bit dated, doesn't quite show what's happened here. I've got that in the next slide. But what was more important here is, I've used this in a number of presentations, volatility is not risk. Volatility is normal. You can see it here. It is up and down on a daily, weekly, monthly, yearly basis. It's normal. It happens all the time. Doesn't make us feel good. If it doesn't, stop looking at your portfolio. So it is a normal thing, and I spend a lot of time teaching and explaining that this is how markets work. They trade every day. We can be in and out in an instant, so we're going to get lots of variations. But businesses, are solely focused on their products and services and their clients. So here's a series of charts. Again, All Ords. This is 6 months. You can see the volatility is there. Here's the peak that we just saw, and here's the correction that we're going through right at the moment. And a little bit of recovery there, but it's all short term. If we extend it out a little bit, a 3-year chart, there's the COVID crash. From top to bottom, that was just under 40%. That's a significant crash, and subsequent recovery. Over the 10-year chart, again we can see significant crash. That's the COVID crash. But again, if we start to draw a line from bottom to top, then we're not overly worried about what's happening in between. Obviously, that is significant. That was clearly a buying opportunity. And then if we look back from 82 through to now, there's the 87 crash. That was 50% down at the time. There's the GFC, there's COVID, and the tech wreck is in there as well. Around this part here, the Aussie market didn't get hit as much there. That's because we didn't have much in the tech space. The US market definitely copped it there. And so if we draw a line from top to bottom, it is an amazing performance over the long term, but just lots of bumps in the middle. And the last graph that I was keen to show you, and this is from Peter Thornhill, and on our website we have his video series there, well worth watching. And at these times where there's a little bit of worry or stress, it's well worth going to have a look. But our alternative to investing in the market, where you say, well, I don't want my money to go down, is always term deposits. So this dates back comparing the all industrials businesses to term deposits since 79 to 2020, with all the income taken. And you can see here is the capital value of the businesses, the shares, which is $2 million at that time, and your $100,000 in a term deposit is still $100,000. We know the income on a term deposit is just minuscule, not even worth mentioning on $100,000, $400, $500, and on average you can see here that it's been around $80,000 per year. So I hope that helps, gives you an idea of how I think about the markets over very much long term, the things that I read to understand the businesses, and if we understand the businesses, it'll give us a lot more comfort. Thank you for listening, and we'll see you in the next video. Cheers.